Hello, investors. Thank you for joining us. Today, we're going to talk about multiple and what that means to investing. So this is Investment for Beginners, and my name is Michael, and I have a newsletter called Deep Value Returns, where I talk to you about the hybrid stock portfolio. This is high growth stocks and low growth stocks. Over to you, Manuel.
And I'm Manuel. It's a pleasure to be here with you, Michael. You can find all my work over at allinstocks.com. Let's go to your topic, Michael.
Hey, so it's very exciting for me. This is a topic that really is something that really resonates with me. So I'm going to talk about multiple, what a multiple means. So a multiple is the price that you pay either to the sales or to gross profits or to earnings. Typically, a person would have paid historically a price to earnings ratio. And let's say a price to earnings of 6 could be perceived to be a cheap stock. A price to earnings of 30 could be perceived as being reasonably priced. And a price to earnings of, let's say, Teslas at 250,000 could be perceived as being expensive. So if you think about the price to earnings, it's a shortcut for thinking about how it's valued relative to itself and relative to its future potential and relative to its competitors, okay? So the price to sales or the price to earnings is called the multiple. The multiple is so important because when you pay for a stock, if you're lucky enough, you pay for the stock when the multiple is low and the company is growing, and investors come around to a different way of thinking and they see that the company is growing at a reasonable rate and they pay a higher multiple as expectations or confidence or the perception of the company improves. That could be because the business is taking on a new acquisition. That could be margins could be expanding. For example, in the past, we talked about Apple, and Apple hasn't really grown a lot, but the multiple has expanded. So the multiple is also sometimes called a re-rating, the re-rating of the stock. So when a stock is doing really well, the multiple is high. And when the stock is not doing so well, the multiple compresses. So last week on Friday, actually Thursday night into Friday morning, Snap, a digital mobile social media platform, Snapchat, reported some results. It missed fractionally on the growth rate, and the multiple just totally collapsed. So the stock was down approximately 25%. And it leads you to believe that even if the company continues, the expectations from investors is that the company is not going to be doing as well in the near term, so the multiple compresses down. Now, you can write or you can explain this multiple and you can add a lot of different adjectives here. So I was reading Michael Maurício's book, Think Twice. It's a reasonable book. It's kind of like super forecasting or think again. It's really about how you get a lot of data and sometimes you have the inside view. The inside view is like an anecdote. I'll tell you, for example, hey, if you think about a streaming company, you think about Netflix. Therefore, the next streaming company that you own, like Fubo, is going to be the next Netflix. Therefore, you should buy it now. That's the inside view. Because X, Y, Z has happened, you look at that one specific anecdote, that one specific story that has worked out quite well, and you buy the stock. The outside view is where you take a lot of different...
No, I didn't mean to interrupt you. The outside view is very...
Yes, the outside view is where you take a lot of different comparables. So you look at, for example, okay, how has HBO or how does Hulu, how does Disney, and you take a lot more points around it to get a more of a comparable base universe. So that's the outside view. The outside view is where you spend a bit more time thinking, and it overlaps quite nicely with, let's say, thinking fast and slow. So Daniel Kahneman has the system 1 and system 2. System 1 is where you kind of you use your hunch, intuition, and system 2 is where you kind of slow yourself down and you think about something in a bit more logical way, not using your hunch. As Peter Lynch says, it's not about listening to your gut, it's about ignoring your gut. So it's the same, all these themes are the same. It's about you having a point of view and you trying to believe where the company can go over time, and you're trying to get the company, well, investors don't really see that side of the equation, they don't really see the potential of the business to grow. You get into the stock at a low multiple and it expands out. And as it expands, you get a lot of analysts say, oh, the company is going to do amazing. Then you can add your own adjective afterwards. You can say the company has a lot of leadership. The company is innovative. The company is bold. You can add whatever adjective you want because the share price is going up and everyone will kind of piggyback on the back of that. But then Snap misses results and the stock is down 25%. And then everyone's like, poor execution, they lack vision, they were slow-footed. You cannot then whatever adjective you want, and the share price compresses down.
I'm yet to take a look at Snap's earnings, but from what I've seen on a Twitter comment, it didn't really miss the estimates, did it?
It missed by a fraction, like 30 million of a 1.1 billion in revenue. So I mean, it's less than a decimal point. It's really just a rounding error. They should have fired the accountant for that rounding error. And that's the story, right? Expectations are high. The multiple is high. You need the business to outperform the consensus. It doesn't matter so much if they miss on the earnings. That's fine. Everyone's fine. Everyone's investing for growth. That's fine. Everyone will eat that away. But if you miss on the revenue line, it's game over for the stock. Not like it's just, that's how it is. And incidentally, it's quite interesting because looking out even into next quarter where they have the very tough comparable with the previous year, Q4, where it was very strong for advertising coming out of the COVID. And secondly, they have this whole privacy issue. So even against those very two difficult comparables, this company is still guiding to grow at approximately 32% year over year. So it's still a reasonably fast growing company. And just because it missed so marginally, 30 million out of a 1 billion in revenue, investors are like, off with the stock. I don't own the position. I'll have no position in the stock. I'm just fascinated. So what actually happened in the case of Snapchat? It's about they don't have a lot of first party data. So they rely a lot on third party analytics to be able to track how an advert does. So typically in the past, what an advertiser would do is you load some kind of analytics and you're able to compare how your advert does either against, let's say, within Snap's ecosystem, how it does across different platforms as that advert kind of gets spread out and distributed to different places. You're able to check the analysis. You're able to check how many people see it, how many people click it, what's the conversion rate. You get a lot of different information to that. But right now, in the case of Snap, so they're able to give you some analytics for within their platform, but you're having to rely on Apple's analytics to check how it does intra-platform, so against other platforms. And you're having to kind of optimize your advert within Snap for this software, and then you have to kind of go to a different platform to check how it does within Apple's ecosystem. So it's become like a bit of a confusion point for a lot of advertisers, because for 10 years, they've been doing things one way, and then in 6 months, they had to adapt and change the whole business model.
Will that be the same for Facebook?
That is the same for Facebook. Any company that relies a lot on third party, that doesn't really have a lot of primary data, it's going to be like that. It's going to be like that a lot. But that's already.
Do they rely a lot on third party, Facebook as well?
Yeah. Any time that you're kind of accessing via like a desktop or something that you're not really getting within the app itself, it's going to be like that a little bit to a certain extent. But they've talked about, Facebook has already talked about that as well. Sorry, man.
No, please go on.
So all I was going to say was, it's quite interesting for me an investor. I've often said that the one thing that defines my investment strategy is I want to buy businesses that are poorly understood today, with the expectation that over the next year or year and a half, people see things slightly differently and the multiple expands and I get the stock on the re-rating and I get my margin safety because the business is also growing the same pace. So I don't own any position in Snap, but this is just for the case of the description here. So in the case of Snap, it's growing right now in this difficult comparable quarter into Q4 at 30%. They had previously said they would be growing sustainably over the next 2-3 years at 50%. So now they're growing at 30 for this interim period. So if you buy into Snap, for example, this is not a advice, I'm just kind of saying, I don't own the stock, I have no position, but if you buy into Snap today and you own the stock for 2 years and the stock, the company is able to continue growing after this period right now, it goes back to growing at 50% as they said they would do, and investors' expectations come a bit higher again, you get a double margin of safety. You get in the margin of safety because the intrinsic value of the business is growing over the next 2 years, and the multiple expands. So even if one of them doesn't really work out very well, if the business doesn't really grow, let's say at 50%, it grows at 45%, or even at 40%, and the multiple only expands a little bit, or even just stays the same, it's not, you get a meaningful amount of margin safety, because if you hold this business for 2 years, you get more likely close to 40% or even maybe 45%, which is kind of approximately 20% compounded annual growth over the 2 years stacked together. So anytime you make an investment and you don't lose a lot of capital, you can continue playing that game for a little bit longer. Sorry, I interrupted you. Were you going to say something?
I was, you research more businesses with no profits than I do. That's at least my current feeling. And I wanted to, I get a hard time, or it's hard for me to look at sales or revenue multiples.
Okay.
And you've mentioned at the beginning, when you compare it to competitors, and the difference between, you usually start with price to earnings and then you go up the income statement. The first thing, relative to competitors, I do that as well as a sanity check, but who says that you must understand the competitors very well as well to understand if they're overvalued or not. So that part of the evaluation, it's a limited use, I think. And I think people, at least when I read other investors' pitches or write-ups, I think people tend to stick to that comparison a lot. Like, this guy is trading for 60 times, so mine at 50 is cheap. It might not be that simplistic.
Absolutely. So,
right? But and then you can join both answers in one. And then the P multiple, I like it because if you invert it, it tells you the initial yield without any growth, of course. But how do you say that 40 or 30 or 20 times revenue is cheap or expensive? Because there's a lot after that on the income statement, right? So this is completely being honest. How do you work with revenue multiple?
Okay, so the first thing to say is that the accounting, the way it works, is that it's kind of complicated, because the accounting, if you're investing in the talent of your team and you're paying them in stock-based compensation, that depresses the earnings. So you're going to end up looking unprofitable. But actually, if you are, let's say, a retailer and you're having to buy a plot of land to build your brick and mortar store, it's still an expense. So whether the expense, in the example of the brick and mortar company, it goes into capital expenditures, goes into CapEx. So you have a lot of earnings, but 50% of those earnings get plowed back into the business as capital expenditures or CapEx. In the case of, let's say, a software company, its earnings are also low because it has to invest in the talent of the team via stock-based compensation. So the accounting is kind of, the retailer on the surface looks very, very cheap and it makes a lot of earnings, but the quality of those earnings is ephemeral, doesn't last a long time, because you're having to keep renovating the shop or the place or the factory, whatever. So the accounting doesn't really keep up with this way of these businesses, because these businesses are kind of asset light. You don't need a lot of capital to be put into the business. You just need to pay them the stock. If the stock goes up, you pay them. And if the stock goes down, they're going to leave anyway. So you don't have to worry about that. But
what I was thinking is, if you look at, I don't know, let's say Cloudflare or whatever, and you look at Twilio, and one is at 60 times revenue and the other one is at 45 times revenue. There, and I don't nothing about both businesses, but
okay, but I'll give you the answer.
But then the profitability, without taking into account that accounting is it's not perfectly accurate, but you're going to have different profitability profiles.
Absolutely.
So what does the multiple tell you, right?
So
what I'm trying to understand is that.
So for example, let's say that Cloudflare is growing at 45% revenue growth rate, the 45%. And you're in this case with Cloudflare, you're paying 68 or 67 approximately times forward sales. That is expensive. You're paying like a large multiple relative to its growth rate. Now, on the other side of the equation, if the growth rate is 30% and you're only paying 10 times forward sales, it may, not necessarily, but it may have some margin of safety. Not necessarily, but it may. So it's just a proxy. Now, you need to see where, for example, the business's gross profit margins lay. So, for example, in the case of Cloudflare, you're getting close to 80% of gross profit margins. So it's a very high margin business. So once they stop investing as significantly in their sales and marketing team, that comes back out because you already landed and you already got, for example, in the case of Cloudflare, you've already got the federal United States federal agency on board. You already have that contact with them. You don't need to get a salesperson to go in and land that contract. You already got that contract. It's just a multi-year contract. So it just keeps rolling forward. You just keep raising the price every year by 15% or 20% for the same access to the platform. So it's a subscription business. So it's very, very sticky. I'm not validating by any stretch of the imagination that Cloudflare is an attractive business at all. I'm just saying that it kind of makes sense because the business is quite sticky and you're just able to every year just ramp up a little bit the subscription model. On the other side of the equation, if you have, like, say, a business that has very low gross margins and you see that a good example. So ServiceNow, I know you're not very familiar with ServiceNow, but ServiceNow is a software platform and its net retention rate is approximately 95%. That means there's a bit of a churn out of the customer. So the kind of customers come in, they play around, they stick around, and then they leave. Over time, that customer is not that sticky, so it's not as attractive. So that's why the multiple that you're paying for a business like ServiceNow is only 18 times forward sales, and the one with Cloudflare is 67 times forward sales. I'm not making the argument that Cloudflare is a good business. And I'm not saying that necessarily ServiceNow is a cheap business. I'm just saying that the multiple gives you a little bit of an insight. It's not perfect. It's like you can use a DCF. I'll give you an example. So if you look at, let's say, Costco started in 1990s to 2000, you have a very good cash flow business there, and you'd make a DCF calculation. Your ability to show to 10 analysts that DCF multiple, discounted cash flow multiple, and you say, okay, tell me how much Costco is going to be worth in 2020. Nobody or planet Earth is going to get the figure right. And so do you use a DCF? Well, that's not really good because you're kind of trying to extrapolate the next 10 years. So we have no idea what's going to happen in 10 years' time. Do you use a multiple? Well, the multiple is prone a lot to mishandling. It's a bit too much of a shortcut. So it's difficult to have the right thing. But what I do believe is quite helpful for you to kind of get familiar with how different companies do in different spaces and try and say, okay, this type of sector goes this valuation, and it's been like this for approximately 3 or 4 years. It doesn't necessarily mean the next 3 or 4 years it's also going to be similarly valued, but that's been the argument for a lot of value investors. A lot of value investors said, okay, everything is overpriced and I'm not buying anything. I mean, like, it's difficult. These discussions are very theoretical and it's always so difficult. But what I do know for sure is that in hindsight, it was always so clear. So yeah, you don't really know. Yeah, that's done. Let me just think something else to talk about. So, I mean, it's quite interesting because we're kind of going into earnings season right now. So everyone's kind of, I love when one of the first companies in earnings seasons kind of does something quite badly, because then that becomes the overarching narrative for the rest of the earnings season. So Facebook reports tonight and then Twitter tomorrow night. And so the whole earnings season is going to be about ad tech companies, how ad tech companies do with privacy, which ones have been successful, which ones have not. I think it's going to be a very, very interesting period for investors. Is there anything else you want to add for us, or shall we wrap up here?
I think we should wrap here.
Okay. Thank you very much, guys. See you next time.
Bye, guys.
Bye-bye.